How about I begin this video with a very big, warm welcome to all of my good friends out there, or just my friends in general, or just anybody who decided to come by and watch this video, because today I'm going to give you a doozy. That's right. And I'm only doing this video for two reasons. Number one is I want to warn you. But the second, which is always the best, is I'm here to educate you. And I'm going to be doing it good. I'm going to be breathing fire today. Like, think I'm going to take all the knowledge I've got, and I'm going to wrap it up into this ball, like a cannonball, and I'm going to stuff it in the cannon. Boom! Right at you. That's what we're going to do today. Okay, all kidding aside. I love a good intro like anyone else. Doug here with Trade with Doug. We're going to talk about something very important today. A topic of all, is this market going to crash? Are we going to see a crash? I want to give you my thoughts and feelings on that. And we are going to talk about it. Before I start, as always, if you need help with your personal trading, find me. You will either find a link on this screen or down in the description box, you will find something that will direct you to the live trading community. Now, I want to first say that a market crash is a word that has been very abused in my time. I mean, what's a bubble? What's a market crash? What does that really mean? I mean, if you're one of those people that are constantly on the doom and gloom side and you're sitting here constantly thinking about a market crash, that is a bad thing. Because there's been people calling for a market crash when these indices were trading thousands and thousands of points ago. And even if they correct now and enter bear market territory, they're still twice as higher as the fear-mongering crowd. I, however, use technical analysis, and I'm going to share you some things because market corrections themselves happen on a regular basis. And one of the things that will really excel your trading results is understanding when you're reaching important levels, both technically and fundamentally, and how you should react and prepare. I always say there's never a bad trade if you're prepared for it when you go in and you've rehearsed all the scenarios that could happen and you've thought that through. So what I want to look at first here is the NASDAQ. You can either look at this with the Qs to the QQQ, but I want to use just the futures right here. The same rules will apply. To me, this is the more important asset that we need to be paying attention to outside of the S&P 500 and outside of the Dow. There's a little bit of money rotation that's obviously happening now in the market, where the tech leaders, the growth leaders that got us out of the coronavirus correction and went on these long 30, 50, 150% run-ups have now fallen out of favor, and that's understandable. While in the same turn, with much of the coronavirus data coming out that's been positive, thank goodness, that you've seen some more money moving into airlines and travel stocks. Hence, you're seeing the Dow perform well. But markets always have a tendency to operate in unison. And what I've noticed over the time, whether some people disagree with me or not, that the Q is normally a leader. So it was the first to recover from the correction, and it drugged the Dow and the SPY out of the hole. Here you may see something opposite, where that if it sells off, the pressure of the sell-off will move the remainder of the markets down. And the only reason I'm again doing this video in addition to that is because we're at such a pivotal area that we really need to be focused today. So by the time you get this video, maybe some of this has already happened, and I just want you to be prepared if nothing else. So let's go back and take a look at this. And we begin for the last few days is you've had some pretty aggressive moves inside of this market. And one of the things I always wanted to translate to people to understand the differences between bull and bear markets is bull markets are not volatile. They're just not crazy and unstable. Bull markets are directional and free of heavy pullbacks, drawdowns, and any kind of negative movement. They're sort of just very linear, and they have this nice trajectory to them. And then you get up in here and you start to see a change in that rhythm where you have a standard dip, but it does not get bought up, and it enters this very strong back and forth, extremely volatile, expanded range. So when I'm talking about range, I'm talking about how something moves every day. So if you look at the NASDAQ, you might have normally gotten just between 50 to 100 points. Excuse me. I got to make a joke here real quick. I'm terrible at writing. Remember when I used to do the whiteboards, guys, and I would write? My penmanship was terrible. It sucked. Now here I am expecting I'm going to write with a mouse. Please bear with me. So you get between 50 and 100 points, and your range now has moved into more like 400 points. So this additional range expansion, whether it's per share based on a stock you're trading or points based on an indice, the fact that you have this double to triple expansion, of quadruple in this case, expansion of range means volatility. Volatility normally signals corrections and bear markets. Now, I'm going to say right now, I do not believe this market enters bear territory and stays there, but just a small correction at these elevated prices could be, as some of you may be already witnessing, we've pulled back about 10% here, could be catastrophic to your portfolio. Now, I want to go back and focus on why this video is important today, because I talked about this in the market mutterings. I don't know, this is like the 12, I got to squint to see this, I apologize, 638-ish. You want to go back here, and you're going to see quite a few support pieces of this that take us back to roughly January. So we're talking about the very beginning of the year, the entire years of gains here. You have a strong support structure right here where this is sitting right now. One of the things I always like to tell traders is this, and I think it's very important for all newbies to understand this, or struggling aspiring traders. Not every level is created equal. One of our jobs is to assess what it is we're looking at and the validity at what we are looking at. What does this mean to the market? So when we're talking about trading on small time frames like 1 minute and 5 minutes, those levels are, let's call them sketchy. They're levels that we can work with and use for risk management, which is vital and important, but they're not this most solid, astounding, ironclad type of levels. Now, maybe sometimes they are, but just for the sake of this talk today, they're not. When you go to daily charts, you start to move back. The further you go in time, the more important we're looking at. So let's say we use a scale like I always do from 1 to 10, and we want to diagnose what does this level mean to the NASDAQ. How important is this? And I think you're pushing somewhere at 8 plus or better. So this is a very important level. Why is that? It goes back to the beginning of the year. It's the lows for the year. It's bounced off of that once here, 3 times here, right? 3 times here, and it's touched this 4 out of the last 5 trading sessions. So you're looking at an area that has been tested 10 times since the very beginning of the year. That is important. Now, each time it's bounced off of that, but now we're seeing yet again more aggressive selling that is pressing us into this area. And now we have yesterday's close, or today's open, which is just slightly dropped that below. Now, when you have a level like this, there's one thing that you will accomplish, and that will be whatever answer you're looking for, you're going to get it right away. And maybe by the time you watch this video today, you will have already had it. And that is, something is going to happen here. Either this market will finally establish this as a low from multiple testing, and you will find your way back up to a high like we've seen so many times in the past, or you are going to get probably some sort of a bounce just for the sake that it's being here. But any re-rotation could lead you down into these other areas. So let me explain this to everyone to make it a little easier. I like to look at these and use the analogy of apartment buildings. I want you to just bear with me. So when I look at range, I just kind of draw this imaginary box. Okay? And I say, okay, like let's just call this the 4th floor, just for the sake of this chat today. And each one of these levels below represents like a floor, like we're in this big old cool condominium. Maybe you can draw some nice windows in these condominiums or whatever, you know, maybe a rooftop pool. I don't know what you want to do. But what's happened is you are trading inside of this range. So if I'm using this room that I'm sitting in, that would be the floor and then the ceiling. So when you're a trader, the theory is to buy as you move closer to the floor, sell as you move closer to the ceiling. And many times stocks and assets will trade with inside of this imaginary floor. So consider yourself looking for help, for example. Markets will do the same thing, look for help. And you've run out of gas or something, and you go to the 4th floor and you're looking for help, and you go knocking on everybody's door, and no one's answering. So you need to move to another floor to find the answer. somebody help you. You either go to the 3rd floor or you go up to the 5th floor, but you keep going. If nobody's there, you keep going somewhere else. So what I'm saying is markets do that. Now that it's established this area, it needs to attract buyers here. Or what it will have to do is find another floor where they might be hiding. So you may have to go down into here and start exploring this space. And if you go down there and you cannot attract buyers there, you will have to move down to this space. That's just simple stock market technical analysis. There aren't really any randoms in markets. You trade from one level to the next level. So what's happened is unless you can get above this, you may attract more buyers up here, but all you're attracting right now is sellers. What do I mean is that this level gets taken out. You will probably stand roughly an 80% chance, in my personal opinion only, that if this does not hold, that you will end up trading back down into this space or into this space. Now, it may not be all at one time, but that's what you will have to be prepared for. Now, that's what I want to focus on for just a second. As traders, our job is being prepared. I have no clue, just like everyone else in the world. I am not going to tell you that it's going to go down or it's going to go up because I simply don't know the answer to that. This market has had more lives than a cat. Many times it looks like it was going to be written off. For example, pre-election, looked like it was going to go down here too. What does it do? Goes on this linear, super bullish run. Now you come back through another correction. Is it going to go through another linear, super bullish run? Well, the answer is none of us know. And that's what we need to focus on. We don't know. We must let this market tell us, then we react accordingly. So when I'm saying now that we're in this spot, I don't think we're going to get a market crash. Maybe we end up down here, which I think my math might be wrong, is about a 15% correction from highs. That's really standard in any given year. So what we're going through isn't anything special. What I don't want traders to do is get caught off guard, being too biased to the long side and too overloaded to the long side when you're sitting at such a critical level, because if you don't hold, the ramifications here is probably another 6 to 7% drawdown. So if you're in high beta, maybe that's another 20% of your account. That could be catastrophic, and you need to be prepared or think that whole scenario through. So that's what I'm looking at here. My technical analysis opinion here is leaning a little bit, if I must, for the sake of an argument, create one, I would say it's leaning a little bit more to the bearish side. Now, the reason for that is because of these instantaneous wipe out sell bars, this retaliation of aggression, let's call it, this dramatization of aggression, okay? You're looking at a market that rallies for 2 days and is completely stuffed and trades back down to low. Bounces yet again off of it, trades for 2 days green, immediately sells off. So the selling now, rather than the buying, like back here, was a long, slow, drawn-out, multi-day sell-off, followed by 2 days it's gone. Here, the reverse. You start with aggressive selling, weak bounces. So you have the opposite in reverse. So that's leaning me a little towards the bearish side, that what we're looking for is not at this level. So in a closing, I want you guys to always remember this about technical analysis in general. We can make all the assumptions and analogies and analyzing what we want to do, but these are simply markets that move from one level to the next. There's no randoms. There's no secrets involved in any of this. It's a simple strategy of supply versus demand. So the markets will always trade very high until people look at them and go, no, it's too high. I don't want it. Just like you look at any kind of commodity in this world, right? You drive your car, you look at gas, that's fine. Next day it goes higher. Next day it goes higher. Eventually it can go high enough. You're like, I'm not driving. I will quit driving until the prices come down. And then that's what happens. No more buyers. Then the market begins searching for them. Maybe it drops here. Like we say, nobody's interested. We want lower. Then it goes lower. Okay, we want lower than that. Okay, we want lower than that. You never know when the market is going to decide, okay, that's low enough. You're never going to say when the market says, that's high enough. Maybe it just wants to chase. Maybe it wants to go on bubble patrol. Maybe it wants to sell off. We don't know this. But I want you just to pay attention very close to this today. We're at a vital area, something we really need to pay attention to. Depending on what time you watch this, I would say if you close down here, guys, you need to be extraordinarily cautious with longs. I would cut most of my exposure to tech stocks or high beta, because the chances are you will explore these lower prices. And the beautiful thing is you can always buy back if you're wrong. So also, guys, I just don't want you to drink the Kool-Aid. So let's say this is a Kool-Aid cup. I just want your Kool-Aid level to be like right there. Just that much Kool-Aid. I don't want you up here overflowing out of the glass. I don't want overflowing of Kool-Aid. I want you to be safe. So as always, guys, I want to thank you very much for watching this video. It's always a pleasure to talk stocks with you, to talk shop with you, and if nothing else, just try to entertain you and make it the funnest I can possibly do. If you need my help, you know where to reach out to me. Trade them well, guys. Take care, and I will talk to you soon.